Hey everyone, and welcome back to the channel where we demystify the markets and scout for unique opportunities. Today, we're diving deep into a stock that's showing some incredible signals on our hard-to-borrow screener, the Growhub Limited, trading under the ticker TGHL. We're going to break down why this stock is catching our attention, what hard-to-borrow actually means, and what it could imply for its future price action. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show TGHL logo/chart. Let's zoom in on the Growhub Limited, or TGHL. This company operates in the technology and software infrastructure sector, specifically focusing on product traceability, data analytics, and product trading facilitation solutions in Singapore and internationally. With a market capitalization of just $18.06 million, it's firmly in the micro-cap territory. TGHL has an estimated float of 12.7 million shares, which is the number of shares readily available for trading in the open market. This can be a key factor when looking at squeeze potential, as a smaller float often means less supply to meet demand. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why should you care? When a short seller wants to bet against a stock, they first need to borrow shares from an existing owner, typically through their broker. They then sell these borrowed shares, hoping to buy them back later at a lower price and return them to the lender, profiting from the difference. But borrowing shares isn't free. There's a fee called the cost to borrow, or CTB. This fee is paid by the short seller to the lender. When a stock becomes hard to borrow, it means there are very few shares available to short sellers, and the demand to short those shares is high. This scarcity drives the CTB fee sky high, sometimes even exceeding 100% on an annualized basis. Think of it like a rental car. If everyone wants the last available car, the daily rental fee goes through the roof. Why this stock is hard to borrow right now? And this is precisely where TGHL enters our radar. Our screener flagged the Growhub Limited because its annualized cost to borrow fee is an astronomical 773.1%. Highlight 773.1%. That's an extremely high fee, signaling significant scarcity and demand to short these shares. We currently show unknown for the exact number of shares available to borrow, which often means the supply is either zero or incredibly low, further tightening the screws on short sellers. While we don't have CTB momentum data for TGHL right now, the 773.1% figure alone is a stock indicator. Our internal composite squeeze score for TGHL sits at 46.5 out of 100, which suggests it warrants attention, though it's not a top-tier score yet, indicating other factors might not be fully aligned for an immediate explosive squeeze. Squeeze mechanics explained. So, how does this high cost to borrow translate into a potential short squeeze? Imagine short sellers paying 773.1% annually just to hold their positions. That's nearly 2.1% per day in fees. If the stock price starts to rise, and TGHL has seen some notable movement recently, up plus 17.57% to date, plus 9.69% in the last 5 days, and an impressive plus 61.5% over the last 30 days, these short sellers face a double whammy. Their unrealized losses grow, and their daily borrowing costs continue to eat into their capital. At some point, the pressure becomes too great. They're forced to buy back the shares they borrowed to close their positions and stop the bleeding. This forced buying creates demand, which pushes the price even higher, triggering more short sellers to cover, leading to a cascade effect we call a short squeeze. It's a vicious cycle for shorts, but a potential rocket ship for longs. However, it's crucial to understand that a high CTB does not guarantee a squeeze. It can also mean short sellers have incredibly strong conviction that the stock will eventually fall, and they are willing to pay a premium to maintain their short positions. Dilution risk check. Before getting too excited, let's look at dilution risk, which can significantly impact a squeeze thesis. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically dilutes the value of existing shares and can provide an easy supply of shares for short sellers to cover, negating any squeeze potential. For TGHL, we found no recent dilutive SEC filings, no -1s, -3s, or 424 BS in the last 90 days. This is a positive sign, as it suggests the company hasn't recently flooded the market with new shares that could dampen a squeeze. No reverse split has been found either, which can sometimes be a precursor to further dilution or indicate underlying financial distress. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For TGHL, the immediate price action is interesting. Today's volume was 619,400 shares, which is relatively low at only 0.1 since 30-day average volume of 9,657,443 shares. This low relative volume on a plus 17.57% day could suggest that the recent price appreciation is happening on thin trading, meaning a small amount of buying pressure is having a significant impact due to low liquidity. To see a true squeeze develop, we typically want to see sustained price increases accompanied by a massive surge in volume as short sellers scramble to cover. Watch for any updates on shares available to borrow. If that number drops to zero and stays there, alongside increasing price and volume, the pressure on shorts will intensify. The Growhub Limited, TGHL, presents an intriguing case study with its astonishing 773.1% cost to borrow fee. While its current squeeze score is moderate and volume is low, the extreme scarcity of shares to short makes it a stock worth watching for educational purposes. Remember, high CTB is a warning sign for shorts and a potential indicator for longs, but it's just one piece of the puzzle. Always combine this information with your own thorough analysis. If you found this breakdown helpful, please hit that like button, subscribe for more unique stock insights, and let us know in the comments what other hard-to-borrow stocks you want us to analyze next. Thanks for watching, and happy trading!